Welcome back to the deep dive. Today, we're digging into something really fascinating. It's where tech, money, and global power all collide. We're talking about China's digital yuan, the e-CNY, and how it's strategically, pushing against the big players in global finance,
Yeah.
the U.S. dollar, and that SWIFT network everyone uses. We've looked at a whole range of sources, financial analysis, technical stuff comparing digital currencies, and of course, the geopolitical angles too. The idea isn't just, hey, here's a new digital coin. It's about how this tech might actually reshape, well, financial independence for countries.
That's exactly it. So our mission for you today is to really unpack this. Is the e-CNY a genuine disruptor? Like, is it really going to shake up dollar dominance? Or is it maybe just a shiny tech upgrade that's going to hit the same old walls, institutional inertia, political realities? Because fundamentally, this is a fight over who writes the rules for global trade in the future. It's about financial sovereignty.
Right. And just to kick things off, here's a wow fact from the sources that really highlights the conflict. Think about it. Right now, sending money internationally often takes days, like 3 to 5 days using the traditional SWIFT system. But China, they're running pilot projects with the digital yuan where cross-border payments settle in, wait for it, 7 seconds.
7 seconds, yeah.
Days versus seconds. That difference alone feels, well, revolutionary.
It really is. And, that difference comes down to how the current system is built. SWIFT, that's the Society for Worldwide Interbank Financial Telecommunication, It isn't actually moving your money. It's more like a super secure messaging system. It tells banks where the money should go.
Yeah.
Over 10,000 banks globally trust it, rely on it.
Okay, so if it's trusted, why the bottleneck? Why so slow?
That's down to something called correspondent banking. Imagine you need to send money from, say, a small bank in Argentina to a supplier over in Indonesia. That payment often has to hop between several intermediary banks first, usually big ones in New York or London, using U.S. dollars.
Right, multiple steps.
Exactly. And each bank in that chain takes a fee, adds delays for its own checks, uses its own systems. It gets complicated and slow. That's why fees are often high, unpredictable, and settlement takes days. It's like sending a letter via multiple post offices globally.
Okay, that explains the speed and cost headaches. That's inconvenient, sure, but maybe not. World-changing on its own. But the sources we looked at argue the real vulnerability, the political one, comes from the U.S. dollar being the world's main currency. That exorbitant privilege, they call it. What does that actually mean in practice?
Well, exorbitant privilege basically means because the dollar is used for everything, oil, commodities, most global debt, the U.S. kind of gets away with running big trade deficits. The world needs dollars, so they keep buying U.S. debt. It gives the U.S. enormous financial leverage.
Okay.
The problem, or the vulnerability, emerges when that leverage gets used as a weapon.
Yeah.
Think about financial sanctions, freezing central bank assets, kicking countries like Russia or Iran out of the SWIFT messaging system, essentially cutting them off from much of global finance.
Oh.
That use of the dollar and the financial system as a tool of foreign policy, well, that really pushes other countries to urgently look for ways around it. It makes the dollar look like a strategic risk for them.
Yeah, that makes total sense. The financial nuclear option, as some call it. If your ability to trade, to function economically, depends on staying in Washington's good graces, you'd have a massive incentive, maybe even an existential one, to build your own financial pathways, right? Ones you control. Financial independence becomes key.
Precisely. It's about de-risking from that dependency.
So that's the weakness in the old system. Now, let's look at China's response with the e-CNY. This isn't just a concept anymore. What are the numbers telling us about its adoption? How big is this thing already?
It's actually pretty big, especially domestically, and maybe bigger than many realize. By this year, 2025, the e-CNY has reportedly reached over 260 million users inside China, and the total value of transactions processed, something like $7.3 trillion cumulatively. And crucially, it's not some separate app you have to download. It's integrated into the big payment platforms people already use. Alipay, WeChat Pay.
Big, huge domestic numbers. But what about the international side? What's the tech that makes it so much faster and cheaper for those cross-border deals we mentioned earlier?
That's where the CBDC, the central bank digital currency tech, comes in. The e-CNY uses technologies like blockchain or similar distributed ledgers. This allows for what's called atomic settlement. Basically, instead of waiting for 5 different banks to slowly update their books over days, the payment message and the actual settlement of funds happen almost simultaneously. Near instant. That's the key technological leap.
And those pilot programs, like the one with Hong Kong and Abu Dhabi, they confirmed this speed.
They did. They reported those transaction times measured in just seconds. 7 seconds in some cases.
Wow. And the cost savings associated with that, the sources had some specific numbers that were just staggering.
Yeah, they were striking. That same Hong Kong Abu Dhabi pilot apparently saw transaction fees drop by, get this, up to 98%.
98%. That's almost eliminating the fee. Think about the sheer volume of global trade. Those savings add up incredibly fast.
Absolutely. And we saw specific examples too, like Middle Eastern energy traders. They reported their settlement costs dropped by 75% using the e-CNY system for cross-border deals with China.
75%. And wasn't there that China-Indonesia payment that took just 8 seconds? For businesses needing fast cash flow, that's transformational.
It really is. But there's a flip side to this efficiency. It comes with a very specific feature, centralization. This isn't like Bitcoin, which aims for decentralization.
Yeah.
The e-CNY is very much state-controlled, and it uses smart contracts. This means the money itself can be programmed.
Programmed? What does that actually let the central bank, the People's Bank of China, do?
Well, it allows them to embed rules directly into the currency. So, for instance, they could program subsidies so they can only be spent on certain things or within a certain time frame. Or they could enforce capital controls more easily, restricting how money moves in or out of the country. From a domestic stability and control perspective, it's a powerful tool. They can manage liquidity much more directly.
I see. Control is the key word there.
It is. But that's exactly where the concerns pop up for international users and observers. Privacy becomes a huge question mark. The ability to potentially track every single transaction, maybe even program limitations onto it, especially given how China integrates digital systems with things like their social credit system or surveillance.
Yeah.
It raises big red flags about potential overreach.
Right. That classic trade-off. Amazing efficiency, but potentially at the cost of privacy and giving up control to the central issuer. Okay, let's zoom out a bit to the wider geopolitical game. China isn't just betting on the e-CNY currency itself, right? They're building a whole alternative infrastructure. What are the key projects here?
Yep. They're tackling this on multiple fronts. First, there's mBridge. This isn't just China. It's a joint project. Think central banks from China, Hong Kong, Thailand, the UAE, and now Saudi Arabia too. It's a wholesale cbdc platform. The goal is to let these central banks settle trades directly with each other in multiple currencies, potentially 70% faster than the old correspondent banking system. It's explicitly designed to bypass those intermediary banks. Still experimental, but significant.
Okay, so mBridge is the collaborative multi-country effort. What about their own system, the SWIFT competitor? That's CIPS, right? China's cross-border interbank payment system.
Exactly. CIPS is meant to be China's answer to SWIFT, specifically for handling payments in their own currency, the renminbi. It's growing, processing more volume. But here's a really important nuance the sources highlight. CIPS isn't fully independent yet. For many international transactions, it actually still relies on SWIFT for some of the underlying messaging.
Ah, interesting. So it's not a complete replacement yet. It's more like they're building their own highway alongside the old one, sometimes still using the old on-ramps?
That's a good way to put it. It's a hybrid strategy. Pragmatic, build out your own system, gain traction, but use the existing rails where you still need to. It shows they're playing a long game and incremental decoupling.
And this ties into their broader digital Silk Road idea.
Yes, absolutely. They're signing agreements, establishing cross-border payment links. We're talking 10 ASEAN nations, 6 Middle Eastern countries. Some analysts estimate this network could potentially allow around 38% of global trade to sidestep the U.S. dollar system eventually.
38%. That's a massive chunk of global commerce. And they're integrating this digital currency into physical projects too, like that China-Laos Railway, linking the money flow to the trade route itself.
Precisely. And another angle is countering things like dollar-backed stablecoins, which are booming in the crypto world. The PBOC, China's central bank, is reportedly developing its own state-approved renminbi stablecoins.
Yeah.
They want to keep control within their regulated ecosystem.
And we're seeing real-world wins, right? Like that oil trade you mentioned. Thailand settling an oil purchase from, I assume, the Middle East or Russia using digital RMB.
Yes, that was a notable example. It might seem small, one trade, but it signals a deliberate chipping away at the dollar's dominance in specific strategic sectors like energy, where China, as a huge buyer, has a lot of influence. It's a slow erosion.
Okay, so the tech is faster, cheaper. The geopolitical motivation is clear escape dollar dependency. They're building the infrastructure, signing deals, getting early wins.
Yeah, the momentum seems strong.
Which brings us to the huge question, the elephant in the room, really. If all that's true, why hasn't the dollar collapsed? Why does it still make up almost 60% of global reserves, while the yuan is stuck under 3%?
That is the core paradox, isn't it? And you're right, look at any global crisis, a pandemic, a war. Where does money flee for safety? Still overwhelmingly to the U.S. dollar, to U.S. Treasury bonds.
So what's stopping the e-CNY, despite its tech edge, from taking over? The sources point to some major structural barriers. What's hurdle number one?
The biggest one, maybe the most fundamental, is capital controls. China still tightly restricts money flowing in and out of the country. For a currency to be a true global reserve, the world needs to trust that they can move their money freely, instantly, without asking permission. If you hold billions in RMB, you want to know you can sell it whenever you need to.
But wait, that seems contradictory. If China wants the RMB to be a global currency, why keep those controls? Doesn't that just undermine the trust they need to build?
From an international investor's point of view, yes, absolutely it does. It looks self-defeating. But from Beijing's perspective, their number one priority is domestic financial stability. They worry that if they fully open the floodgates, a sudden crisis could trigger massive capital flight, destabilizing their own economy. So they choose stability at home over full international convertibility abroad. And that choice creates deep skepticism globally.
Okay, capital controls. That makes sense. And that leads right into the second big issue the sources raise: liquidity and assets. Let's say a country, Germany maybe, sells tons of cars to China and ends up holding a lot of e-CNY. What can they actually do with all that digital yuan?
And that's the crux of the liquidity problem. A reserve currency needs to offer deep, safe, easily accessible markets where foreigners can park their earnings profitably. Think U.S. Treasury bonds, incredibly deep, liquid market, or U.S. stocks. If Germany or Saudi Arabia selling oil ends up with billions in e-CNY, where do they invest it safely and easily within China's system? China's domestic bond and equity markets are growing, sure, but they're still seen as less accessible, less transparent, and harder to get money out of quickly compared to the U.S. markets.
So even if they get paid in e-CNY.
They often end up having to convert it back into dollars simply because the dollar universe offers more places to readily park and manage that cash. Treasuries, corporate bond, etc. The global financial plumbing, you could say, still largely flows back to the dollar because that's where the deep pools of assets are.
Right. Lack of comparable investment options inside China forces people back to USD. Okay, capital controls, liquidity. What's the third major hurdle?
This one's maybe less tangible but just as important: institutional trust. This isn't just about the tech or the markets, it's about the underlying rules of the game. Governance.
You mean like rule of law, property rights?
Exactly. Global investors, central banks managing national reserves, they need confidence in the long-term stability and predictability of the system. They look for strong rule of law, independent courts, transparent regulations, checks and balances that protect their investments. The U.S. system, for all its flaws, has built that kind of institutional trust over a very long time. China's system, on the other hand, is often viewed internationally as, well, more opaque. Regulations can change quickly, sometimes unpredictably, influenced by political decisions. When you're deciding where to hold trillions of dollars for the long haul, that perceived lack of transparency and predictability becomes a major risk factor no matter how fast the payment system is.
Okay, so putting it all together, the e-CNY is like this high-tech marvel. It's incredibly fast, super efficient, potentially very low cost. It solves the mechanics of payment brilliantly. But it's hitting these massive structural walls, China's own capital controls, the lack of deep, accessible RMB investment options, and lingering questions about institutional predictability and trust.
That sums it up really well. The technology is cutting edge, solving tactical problems. But the underlying monetary policy and institutional framework haven't caught up to its global ambitions. The tech might be ready for the world stage, but the system around it isn't quite there yet.
So the race isn't really about the e-CNY just replacing the dollar overnight. It's more like a slow drift, isn't it? Towards a financial world with multiple poles where this new tech efficiency is constantly bumping up against old institutional inertia and trust issues.
Exactly. It's a gradual shift, not a sudden flip. And that tension you mentioned, the weaponization of the dollar, it's a double-edged sword for the U.S. Using sanctions gives short-term power, achieves immediate goals. But every time it's used, it arguably chips away at the long-term trust, that perception of the dollar as a neutral utility. And that erosion of trust is precisely what fuels the search for alternatives like the e-CNY. It pushes countries towards systems outside of U.S. control.
Which leaves us with a final thought for you, the listener, to maybe ponder. Given that even countries like the U.S. are now debating their own institutions, dealing with huge deficits that actually pump dollars out into the world, What changes beyond just new payment tech? What deep structural changes, whether in China or the US or elsewhere, will really decide which currency or which digital system becomes the anchor for global trade in the next 10, 20 years? And how could that shift fundamentally alter the global balance of economic and maybe even political power? Something to think about. Thanks for joining us for this deep dive. We'll catch you on the next one.